prices would be cut by nearly half from their peak last year, and that interest rates would be down into the mid threes from 4.25 at their peak last year in terms of the long-term Treasury yield, I would have told you that growth stocks would have had a wonderful end to the year. And of course, that did not happen. It did not happen because it seems as though investors are waiting for permission from the Fed. So let's go through, as we usually do, fiscal policy, monetary policy, economic indicators, market indicators and signals, and then spend a little more than normal time on innovation, not what is to come, but what happened last year in terms of breakthroughs in innovation, truly disruptive innovation. And it seems like the market's ignoring those as well, which is okay because we feel truth wins out. But we'd like to share with you some very interesting and in some cases mind-blowing developments from last year. So let's start on fiscal policy. We are in the middle of gridlock already. I guess the House can't figure out who the speaker is going to be. Gives you a sense of gridlock, which we'll probably experience until the next national election, roughly 2 years from now. So the good news there is there probably will not be profligate spending, which from our point of view ultimately turns into one kind of tax or another, either outright taxes or inflation, which is accrual tax, or debt, which is a tax on future generations. So that's the good news. Even better news would be bipartisanship. It's hard to believe it's possible. We are hearing more members of Congress, that is, talking about their desire for bipartisanship. So hopefully steps in the right direction. Fiscal policy. The only other thing I'll say about this is we did get what the so-called Inflation Reduction Act last year. It was $1.7 trillion. And I was surprised that it did get through, but it did. And now everyone's heralding it as bipartisanship, which again seems to be becoming a buzzword because the electorate wants it. Of course, the bears on inflation and on the market are seizing that, running with it and saying, this is inflationary, this is inflationary. As I described, inflation can come in many forms. And as I'll describe later, we do not believe that it is going to cause inflation going forward. After all, it's called the Inflation Reduction Act. We don't believe that either, but we do believe that inflation is coming down for other reasons. One of the things that happened in the last 3 months was the COLA adjustment, the cost of living adjustment for Social Security, or it was within the last 6 months. And that was 8.7%. It's based on the CPI. That many people are pointing to as a possible inflation or possibly aggravating inflation. Well, the COLA for Social Security is for retirees. They tend not to be big spenders. It does provide them for some relief from the food and energy price inflation that we've seen. At least they're perhaps able to replenish a bit. But in terms of inflation itself, let's talk about monetary policy. So M2 is now down to zero growth on a year-over-year basis, and that's as of November. It does look like November went negative, and we believe the negative growth rate will continue, if not accelerate to the downside during the next 3 to 6 months. This is a very unusual period. In fact, in my career, I've never seen it go negative. And I've been in the business for nearly 45 years. So this is uncharted territory. And in fact, the last time we saw meaningful declines in the money supply was in the Great Depression, which was, of course, a very deflationary period. So it's very interesting to hear the Larry Summers of the world hearkening back to the 70s in terms of expectations for inflation. He's ignoring a lot of real-time indicators, a lot of market indicators, and we'll spend a lot of time on that in a minute. Now, when I say uncharted territory, if you look at the average money supply growth for the last 25 years and the last 50 years, a very long time, the average money growth has been 7% at a compound annual rate. So, zero negative is a huge departure, and we believe highly deflationary. And we're beginning to see that as I will illustrate as we get into the market indicators. The Fed funds rate went to 4.5% in December, and it does appear that the Fed is determined to take it up again. They want nothing to do with a legacy associated with inflation. And as we've suspected for some time, they are unanimous because there are people like Larry Summers out there saying, you're going to be responsible for another run at 70s style inflation, which was highly destructive. And many times I've mentioned here that the 70s inflation is nothing like the inflation we just experienced. The 70s inflation started in the mid-60s with the Vietnam War, with the Great Society programs, one after another, and then we went off the gold exchange standard and lost all discipline. That's nothing like what we've been through. We have been through a massive supply shock, two of them, COVID-related, and then the Russia invasion of Ukraine. Very different circumstance. One led to lasting inflation, and this one, we believe, as I've mentioned many times before, will be much like what we saw in the early 1920s after a pandemic and World War I. Inflation collapsed. It actually ended up at negative 15% in June of 1921. And we do believe this year we're going to drop below 2%. And in fact, the bond market believes it. The bond market's break-even rate is 2% for the next 10 years. In other words, the bond market is expecting 2% inflation for 10 years. And this is the Fed's goal. The bond market thinks we are already there. And in fact, we believe the bond market will continue to rally, meaning long-term interest rates coming down relative to short-term interest rates, inverting the yield curve. Right now, we're at 70 basis points, a little more than that. And it is interesting now to watch the bond market disengage somewhat from the Fed's rhetoric. And the stock market has not done that yet. In fact, the stock market is behaving like the Fed is right. The energy sector is reaching for all-time highs, even though oil prices peaked in 2008, and we believe are in secular decline. And we'll get into that in a moment. On February 1st, we'll probably see another 25 or 50 basis points. So we will be at 4.75 or 5%. Now, most of the Fed governors are saying roughly 5%, maybe a little bit more, and then we're done. Maybe the Fed will start talking a little bit more about some of the very significant declines in inflation and outright prices that we have begun to see. And again, we'll go into that